You know, whenever the market enters an unpredictable phase, I always remember something an old mentor on Wall Street once told me. The market doesn't shout, it whispers, and only the patient ones hear it. The market never yells at you to tell you what it's about to do. It just whispers softly, and if you're patient enough, you'll hear it. Today, I want to talk to you about one of those whispers echoing through the U.S. stock market, and many other markets too. Money is quietly changing direction. Can you feel it? If you watch the ticker every day, all you see is chaos. Reds and greens flashing like a stressed heartbeat. But if you look long enough, deep enough, you'll notice a rhythm, a flow, a subtle but unmistakable shift. Big money is leaving the hot growth sectors, finance, real estate, and quietly flowing into manufacturing and companies that actually create real value. I've been in this market for over a decade, and I've learned one thing. Smart money always exits before the crowd notices a problem, and it always returns before the good news hits. The funny thing is, most of us only see the big waves after they've passed. It's like standing on the shore, seeing ripples on the water, unaware that an undercurrent is quietly changing direction. In recent weeks, many young investors have asked me, why are stocks in manufacturing quietly climbing while banks and real estate keep dropping? And I always answer with another question. Have you ever wondered why money always returns to where real value is created? For over a decade, capital has poured heavily into banking, stocks, and real estate, sectors that deliver quick profits and hot growth, sometimes exceeding real value. But anything that strays too far from its foundation eventually corrects. We've seen declines of 20 to 30%, painful for those using leverage. And when fear spreads, money always finds a familiar refuge. Real businesses, selling real products, generating real cash flow. A friend of mine, a fund manager in Boston, once said, manufacturing is never sexy until everything else breaks. The manufacturing sector has never been glamorous. It doesn't produce flashy overnight gains or overnight fortunes, but it has something seasoned investors value highly: durability. Think about this. A food company can't raise its product prices 30% in a single quarter. A dairy, plastics, or energy company can't deliver triple-digit gains like tech or finance stocks in their prime. But what do? They expand factories. They optimize automation. They reduce cost per unit. They maintain positive cash flow through every economic cycle. And that's exactly what makes them a safe haven in volatile markets. Here's what I want you to understand. Manufacturing stocks don't rise on rumors, they rise on value. And value doesn't leap. Value grows slowly, steadily, quietly. But once it grows, it rarely returns to its old level. Many people ask me, so why don't I see them surging? Because you're looking at the wrong thing. You're chasing slope. While smart money looks at momentum, I once reviewed the chart of a familiar plastics company in Vietnam. Over 2 years, the price rose more than 150%. But if you zoom in on each segment, you'll see many months where the price barely moved. Nothing flashy. Many investors sold out of boredom, thinking the stock wasn't moving. What they didn't understand, value was accumulating quietly. Day by day, I share this story to remind you. Sometimes the most important thing in investing isn't speed, it's direction. Money flows like water. It moves toward the low ground, the place with the least risk, where it feels safest. And right now it's heading toward manufacturing companies, companies that were overlooked for a decade and are now far too cheap relative to their real value. Do you see it? If not, look again. Look deeper. The market always leaves traces for those willing to observe. And in the next part, I'll help you understand why this money shift isn't just temporary. It could mark the beginning of a whole new cycle. You know, in investing, money never changes direction because of emotion. It changes because of logic, because of patterns we only recognize after watching long enough. And when I look at the market right now, I see a very clear logic. The sectors that led the rally for an entire decade are exhausted, while the ones that were ignored are quietly getting stronger. Let me tell you a little story. A fund manager I know in Chicago once said to me, markets rotate the same way seasons do. You can't stop winter from coming, but you can prepare for spring. And what we're witnessing right now is exactly that. The winter of financials and real estate has arrived, not because they suddenly became bad sectors, but because they ran too fast for too long, and no sector can outrun gravity forever. Meanwhile, the spring of manufacturing is beginning to bloom again. Think about it. For the past 5 to 10 years, manufacturing companies, the ones making the products you use every day, received little attention. Their stock prices were practically frozen, sometimes even dropping sharply. No hype, no overnight riches. But behind the scenes, they kept working. They kept expanding factories. They kept optimizing costs. They kept producing positive cash flow, even during the hardest times. And the market has started to see them differently. I have a habit. Whenever the market panics, I don't look at the price screen first. I look at the cash flow statement. Because prices can lie in the short term, news can exaggerate. But the cash that runs a business, that never lies. And when I look at manufacturing businesses today, I see something reassuring. The money flowing into them is no longer fear money. It's selective money. It's like standing in a crowded city and realizing the masses always rush toward the noise, while the people who understand what's happening slip into the quiet street where real value is smart money is doing exactly that. What's special about this shift is how quiet it is. It's happening through 0.5%, 1%, 1.2% up days. Small steps, steady steps, strong steps. Have you noticed it? The stocks that dropped 20 to 30% in financials and real estate still haven't recovered much. But manufacturing stocks, though slow, aren't falling deeply, even when the overall market pulls back. A friend of mine in New York calls this the quiet strength, a strength only companies with real foundations can have. Ask yourself something. If you were putting money into a savings account, what would you choose? A place with high returns but high risk, or a place with lower returns but stability? Big money thinks this way. Foreign funds think this way. Even individual investors who've been burned before think this way. And that's why in the past few months, foreign investors have quietly returned to buying manufacturing stocks. Not because they expect explosive gains in the next 1 to 2 months, but because they know real growth comes from real value. But I get it. Many investors don't like this kind of slow rise. You can't brag to your friends that your stock jumped 20% in a week. You can't celebrate catching some breakout limit up move. But you can be confident you're holding an asset that time is working for, not against. And that's something almost every long-term investor eventually realizes. Sometimes a bit too late. Slow growth is still growth, and sustainable growth is the only growth that lasts. Have you ever looked back at your portfolio and realized the slow movers were the ones that helped you sleep best? The stocks that went sideways for 2 to 3 months, then quietly climbed 40% over a year? The companies you didn't have to worry about dropping 3% today or rising 2% tomorrow. That's the nature of manufacturing. It's not for the impatient. It's not for those who need fast money. But it is the perfect place for those who want to go the distance. When I say this, I'm not speaking as a theorist. I'm speaking from experience. When you've lived through enough market cycles, you understand something deeply. Investing isn't about chasing emotional highs. Investing is about seeking durability. And durability lies in the place few people look. Businesses that make real products, generate real cash, and hold real competitive advantages. In the next part, I'll show you why this shift in money flow could mark the beginning of a new cycle and how you can make sure you're not left behind. Kunme, have you ever wondered why so many investors end up disappointed while a few quietly succeed without drawing any attention? The answer is simple. They understand real value. They know the market isn't a game of luck. It's a long story about cash flow, fundamentals, and time. You might feel confused watching the market every day. This stock rises, that one falls. I used to feel the same way. But over the years, I realized something. Short-term volatility is just noise. What you need to hear is the true rhythm of the market, where the real money is flowing, where sustainable value is being built. A friend of mine once said, the greatest stocks aren't the loudest ones. They're the ones you forget about until they explode over time. And here's what I want you to understand. If you choose the right businesses, If you follow the smart money, you don't need to chase every green tick. You don't need to panic every time the market shakes, because real cash flow and real value will protect you, quietly but powerfully. Investing is a journey, not a leap. And once you understand that, you'll see that. Every investment decision is a choice between emotion and logic. Every long-term hold is a step toward sustainability. Every market correction is a chance to test your knowledge and your conviction. I want you to look at your portfolio and ask yourself, are your most trusted investments the ones you understand best? Do the companies you hold have real cash flow, real products, and a long-term vision? If the answer is yes, then you're on the right path. If not, it's never too late to adjust. And one last thing I want to emphasize, the market doesn't change, but the way we see the market can completely change our results. Watch the money flow. Look for real value. Be patient and stay the course. Because at the end of that road, the rewards always go to the people who understand and who wait. If you found these ideas useful, I encourage you to keep tracking money flow, learn how to read the market, and focus on fundamentals. That's how you turn investing from a gamble into a smart, sustainable journey. And I promise you this, once you truly understand the market, you won't be controlled by the daily red and green. You'll see it as a rhythm, almost like a living organism you can move with. Not a guessing game you have to fear. So move slowly but surely. Let the money flow guide you. Let real value determine your success. Because in the end, successful investing is about patience, understanding, and smart choices, not speed, noise, or emotional spikes.